Welcome back. And today we're going to be exploring lecture 5, and that's on the expenditure cycle. At the end of this lecture, you should be able to do the following. That's to describe key functions in the expenditure cycle, to describe the flow of expenditure transactions and relevant documents, as well as to analyze key risks in the expenditure cycle and identify internal control procedures to address these risks. Let's dive straight into learning objective 1, and that's to describe the key functions in the expenditure cycle. In lecture 1, you learned that the expenditure cycle comprises business activities relating to the purchase of goods from suppliers and the related cash payment transactions. This diagram provides a bird's eye view of expenditure cycle activities in a business organization. In this lecture, we will just focus on the purchase of goods, although organizations will typically purchase other things like fixed assets for use or even services of various types, such as utilities and rental. Now, a purchase of goods will usually start when low inventory is identified and needs to be replenished, and that's when a purchase requisition is raised. And this is followed by placing the order with an approved vendor. The goods are then received, and that needs to be updated in the inventory records, and the liability recorded in accounts payable. Normally, a 30-day credit is given, and by payment due date, the business will make a payment to the supplier. Now, do take note that in a credit purchase, there is always a time lag between the receipt of goods and the cash payment to the supplier. Hence, we will split the expenditure cycle into two phases for better understanding. One will be the purchaser system that starts from the purchase requisition all the way to accounts payable, and two, the cash payment system. Let's watch a video that gives you an overview of the expenditure cycle. Now that you've gotten an overview of the expenditure cycle, let's look at the flow of these transactions and the relevant documents in this cycle. This figure provides a data flow diagram of the purchaser system. We will once again study the data flow diagram part by part to understand the flow of the expenditure transactions and the relevant documents starting with the purchaser system. Inventory control regularly monitors the inventory levels. Once inventories drop below a predetermined reorder point, a purchase requisition is prepared using information from the inventory subsidiary ledger. If this is a routine order, the name of supplier and standard cost of item are extracted from a valid vendor file. The purchase requisition form is then sent to the purchasing function, who will initiate the purchase process. The purchase requisitions received by the purchasing function are usually sorted by vendor. This facilitates the combining of requisitions from the same vendor into one single purchase order. A purchase order form is prepared in 4 copies, with the original sent to the supplier as a formal request for the order of inventories. Copy 2 of the PO is sent to the AP function. Copy 3 of the PO is sent to the receiving function as authorization for them to receive the goods when they arrive. Copy 4 is filed in the purchasing function as an open PO file. This will then be closed when the goods are received subsequently. After an interval, the goods arrive at the receiving department. The receiving clerk will then reconcile the blind copy of the PO with the goods received. The purpose of the blind copy, that is, the quantity and prices are blanked out, is to force the receiving clerk to count and inspect the goods received. A receiving report is then prepared in 5 copies, with the original sent along with the goods to the stores. Copy 2 of the receiving report is sent to purchasing to close the PO file. Copy 3 is sent to the AP function, and copy 4 is sent to the inventory control to increase the inventory items received. Copy 5 is filed in the receiving department. With copy 4 of the receiving report, inventory control updates the inventory subsidiary ledger. A summary of the inventory received is then sent to the GL function. PO copy 2 and receiving report copy 3 are filed by the AP function in the AP pending file until the invoice is received from the supplier. When the invoice arrives, the AP clerk retrieves the two documents from the AP pending file and reconciles it with the invoice. He then prepares an AP packet comprising the three documents and keeps that in an open AP file. An update is made to the purchaser's journal and the AP subsidiary ledger, since the liability should be recorded when the goods have arrived. The AP clerk then prepares a journal voucher and sends that to the GL function. The GL function will receive the purchaser's journal voucher from the AP function, which is to record the inventory control account and AP control account. It also receives an inventory summary from inventory control, in which the total in the summary should tie with the figure in the journal voucher. After reconciliation of these figures, the GL clerk can then post the journal voucher to the GL and files the journal voucher as audit trail. As an alternative to the AP procedures described earlier, some firms use a vouchers payable system. Let's understand how it works and how it's different from the AP packet. The key difference is that after the AP function matches the supplier invoice with the PO and receiving report, the AP clerk will prepare a cash disbursement voucher, also known as a payment voucher, and assembles the three documents together with the payment voucher as one package. This is to ensure that the documents are intact and also facilitates approval of the payment when it is due. Now let's see if you can answer these questions. We have just reviewed the functions of purchase requisition, purchase order, receipt of goods, inventory recording, accounts payable, and the updates to the GL of the credit purchase. Let's now review the cash payments function in the expenditure cycle, or as we know it, the payment of cash to the supplier on due date. This figure gives the overview of logical activities in the cash payments system. The cash payments system processes the payment of obligations created in the purchaser system. The principal objective is to ensure that valid creditors receive payments promptly and correctly. If payments are made too early, the firm forgoes interest to income that it could have earned on the funds. If they are paid late, however, the firm will lose purchase discounts or may damage its credit standing. The cash payment process begins in the AP department, where the AP clerk periodically reviews the open AP file for items that are due for payment. The AP clerk then sends the payment approval in the form of AP packet or voucher package to the cash payments function. The cash payments clerk receives the AP packet or voucher package and reviews the documents, and they are the invoice, the PO, and receiving report for completeness and accuracy. He then prepares a check, which is signed by an authorized officer after citing all the documents. The check details are recorded in the check register, and the signed check is sent to the supplier. The AP packet or voucher package is stamped paid, and together with the check copy is sent to the AP function for update to the AP subsidiary ledger. The purpose of stamping paid on the packet or package is to prevent the documents from being presented again for payment. A journal voucher is prepared by the AP clerk and is sent to the GL function. A copy of the check is then filed in the cash payment function. Upon receipt of the AP packet or voucher package, the AP clerk updates the AP subsidiary ledger to decrease the vendor balance. The AP packet voucher package is then filed in the closed AP file. A summary of AP total deductions is sent to the GL function. Finally, the GL function receives the journal voucher from cash payments and the AP summary from the AP function. After reconciliation of the AP summary totals with the figures in the journal voucher, the GL clerk will post to the inventory control and AP control accordingly. The approved journal voucher is then filed. Now let's see if you can answer these questions. Now that you have understood the key functions, transactions, and document flows in the purchaser system and cash payments system of the expenditure cycle, let's review the key risks in the expenditure cycle and the important internal control procedures to be put in place to address these risks. Recall that an objective of internal control is to mitigate the risk from errors and fraud. The following are primary risks associated with expenditure cycle transactions. They are unauthorized inventory purchases, receiving wrong items, incorrect quantities, or damaged goods, inaccurately recording purchases and cash payment transactions in journals and accounts, the misappropriation of cash and inventory, and the unauthorized access to accounting records and confidential reports. To mitigate each of the risks, we will be discussing the relevant internal control procedures, which can be in the form of physical control activities or in the form of IT controls. The first risk in the expenditure cycle is making unauthorized inventory purchases. Often, the decision on what to buy, when to buy, and who to buy from can be solely at the discretion of the purchasing staff. You may have heard of several procurement fraud cases, such as the purchase of Brompton bikes by an NParks assistant director at exorbitant prices. Unauthorized purchases can result in excessive inventory when you're ordering items not needed, stock outs when you're not prompt in ordering inventory that's already low in stock, or fraud involving the receiving of kickbacks from unapproved suppliers to benefit from the purchase. So let's review the important physical controls and IT controls to mitigate this risk. Now, in physical controls, we can employ transaction authorization, where there should be a formal purchase requisition properly authorized by the inventory control department when inventory levels have actually fallen below the reorder level. IT controls can come in the form of automated purchase approvals, where a program is written to determine when and what to buy and from which vendor, and these vendor files are controlled by passwords. The receiving department is responsible for inspecting and counting large quantities of valuable goods that arrive from the vendors. Failure to perform receiving tasks correctly places the firm at risk of accepting incorrect items, incomplete orders, or damaged goods. This risk may be due to human errors in counting the items or deliberate acts of theft. To prevent receiving incorrect items or quantities or damaged goods, independent verification by the receiving function is important. The blind copy of the PO forces the receiving clerk to physically count and inspect the goods as independent verification of the goods received. In addition, supervision during the receiving is also critical. The supervisor can take custody of the packing slip, showing the items and quantity, while the receiving clerk can count and inspect the goods. IT controls may also be in use in terms of a scanner technology. product code scanners will reduce the risk of human errors in counting and inspecting the goods. When scanning, the system will verify that the items selected match those on the purchase order. Inaccurate record keeping can take many forms. They include the purchases from vendors being inaccurately calculated, AP being unrecorded, vendor bills for items not received, or even cash payments posted to the wrong vendor accounts. The physical control to mitigate the risk of paying to vendors for items not received is for the AP to only authorize the cash payment function with the AP packet or the voucher package only after having all the supporting documents of the PO, receiving report, and invoice reconciled and correct. The cash payment clerk should not write checks without this authorization. In the area of proper accounting records, the authorizing officer for cash payments should only sign the check with proper citing of all the supporting documents. Of course, all accounting records such as journals and ledgers must be properly kept, as they serve as audit trail that allows auditors to trace transactions through various stages of processing. Another important physical control is independent verification. The objective of independent verification is to verify the accuracy and completeness of tasks performed by other functions in the process. For example, the GL function reconciles journal vouchers from AP function with summary reports from inventory control before posting to the GL for credit purchases. An important input control in any transaction processing system is data input edits. These are programmed into the system to minimize the risk of data input errors. For example, checks can be made for any missing data or invalid data values in terms of data entry for the various functions such as purchasing, AP, inventory control, receiving, and cash payments. Automated posting from the AP to the GL system will not be new to you, as you will be doing this in your practical lab sessions. By eliminating the human element from such accounting activity, the potential for errors and opportunity for fraud are significantly reduced. Finally, file backup is an important IT control in ensuring the integrity of digital accounting records. Any data loss, destruction, or corruption can be recovered with proper file backup procedures at regular intervals. Cash and inventory are the physical assets at risk in the expenditure cycle. In the absence of proper controls, there is a risk of misappropriation of cash by making fraudulent payments to fictitious vendors, or the theft of inventory in the receiving department and warehouse. Physical controls to mitigate the risk include supervision, independent verification, and segregation of duties. In a computerized environment, the segregation of duties are accomplished by having an automated three-way match of the PO, receiving report, and invoice before payment approval, or through multi-level security procedures that limit access to authorized processes and data. Accounting information is at risk to unauthorized access to outsiders and employees of the organization. The motives for accessing information include attempts to perpetrate a fraud, such as creating a false purchase order, the theft of inventory by accessing inventory records to make fraudulent changes, or malicious acts such as corrupting financial data. Physical controls include limiting access controls to source documents and accounting records, and having proper segregation of duties, whereby certain record-keeping tasks are separated. IT controls will be in the form of having passwords and multi-level security to prevent unauthorized access to computer files and programs. You have just completed Lecture 4. Great job! Let's summarize the key functions and documents in the expenditure cycle by reviewing the functions and key documents that flow in and out of each of the functions. This slide summarizes the key functions and documents in the purchases system. This slide shows the key functions and documents in the cash payment system. The other important concepts learned are the key risks in the expenditure cycle and the relevant physical controls and IT controls necessary to address the risks. This slide summarizes the physical controls and IT controls for the first 3 risks. This slide summarizes the physical controls and IT controls for the remaining 2 risks. Now that you have learned the important concepts in the expenditure cycle, you are ready to attempt the tutorial and quiz. All the best!